They say talent hits a target no one else can hit. But genius? That hits a target no one else can see. We make it our mission to spot genius. Technology has brought a once unimaginable change to the world. Education and healthcare have become accessible to millions. Businesses can be run worldwide from a laptop in a coffee shop. And now people can have every song in the world and every restaurant in their city right on their phone. Someone knows what the next revolution will be. Which piece of software will save the planet? We're proud to advise and invest in some of the most visionary entrepreneurs around the globe. People who see a future the rest of the world can't. And through expert advisory, capital, and network, we support founders throughout their journey, helping them revolutionize their industries. There is still a world of untapped opportunity out there. We're here to put technology at the forefront of progress and build a better future. Because tomorrow doesn't happen by accident.
Hello, ladies and gentlemen, and I'm very, very delighted to invite you to our very first, but hopefully one of many presentations that we hold in Zurich. Zurich for us is actually the 12th office around the world. We have offices from US, in San Francisco, in New York. We have 10 offices in Europe, as well as an office in Hong Kong. And the firm was founded in 1999, so we have 20 years of real focus on entrepreneurs. And that's the core of our firm, and that's why we are very focused on local presence. We helped entrepreneurs in over 550 transactions. And what's really remarkable about our firm is that many of these entrepreneurs now co-invest with us. And we look forward to building our presence in Zurich, Switzerland, because it's obviously a key tech hub in Europe. As you all know, and you all are based here, as we've had about 3 billion of investments in Switzerland last year in VC companies. What's remarkable, Switzerland is obviously a very small country. And so in terms of per capita investments, that's one of the highest top 3 locations in Europe. So we are really looking forward to work with you as entrepreneurs, to work with you as investors, and to build further Zurich and Switzerland as well as a hub here. The program for today is very simple. For the past 15 years, we have tech predictions, which is where every year we project what will happen over the following year. And we have, this year, we decided to a little bit change the outline because the world has changed massively over the past month. We've obviously had COVID over the past 2 years, and we had a war that's going on the European continent. So therefore, we wanted to really address the themes that we see over the next year, in particular in semiconductors and payments and supply chains. And then we will address, and the founder of GP Bullhound, Per Roman, together with Ben Prade, who is the head of our investor relations, will address how the world has changed and what we see in the next couple of months and couple of years. With that, I would like to pass on to Inge. And Inge, if you could introduce yourself.
Thank you very much. My name is Inge Heydorn. I am a partner at GP Bullhound, and I run the public side. So I trade the listed stocks around the world. We run a fund called the Global Technology Fund. Just a quick one on that before I go into my presentation. We try to create an exposure to technology which is less risky than a normal fund. So given the last 3 years, our Sharpe ratio has been around 2.5–3%. So we have created the Nasdaq return, but with roughly 40% of the risk, so 60% less risk. That's what we've done in the last 3 years. So over to what I should be talking about today, not doing just a commercial for myself. The global semiconductor market. I want to explain 2 things. The 2 things I want to get out of my presentation today. Firstly, there's not just shortage in general. We need to separate 2 things. Firstly, where is the shortage today? Where could it end tomorrow in terms of we getting supply? And some parts, it won't end at all. That's my message. The second part I want to explain is it's a completely new world when it comes to semiconductors. And I'll try to explain that in a very, very simple way. But if we start with the global semiconductor shortage in the market, it's driven by, as you remember, COVID, supply issues, getting every factory to work, and so on. But there's other things behind it also. It's the general industry, if we talk about very simple components, it's a general industry turning to more electronics in cars, for example. And that's driving demand, which I call the low end. So very, very simple electronics. And the problem there is not just the factories, is that everybody's given up on that. So there's no tools. There is no capacity. So it takes a lot of time to add tools. It sounds ridiculous, but if you think about the leading edge producers, they don't even do tools for these productions anymore. Nobody wants to build these old factories. And that's the biggest problem. But that part is cyclical. That capacity will be added, and it goes up and down with the economy. And that's, we're going to see, so to say, the shortage disappearing. And that's one thing. So that's the cars and so on. But then if you go over to gaming consoles and so on, which is on the leading edge, 5 nanometer and on downwards, that's never going to disappear. And the reason why I'm cocky enough to say that is that, think back, if you think about the semi-industry the last 10, 15 years, we've only been waiting for one company and one company alone driving the industry, Intel. So Intel's been driving the industry. They have been deciding everything we do and so on in terms of development of the semiconductor. That's not the case anymore. There's so many companies now driving the industry that wants the latest, that are pushing this industry further and further and want to be ahead. As you know, Apple is doing their own computer chips now, so the brain, the CPU. You have NVIDIA on the GPU, the graphic cards, you have AI chips. So there's so much money going into the industry, screaming after the latest. So before we had like a roadmap, and we had like the millimeters I'm talking about, and we're going down. Now we have like breakdowns inside of those cycles even to get a little bit smarter than your neighbor. So what I'm telling you now is that we think this is going to last for a long, long time. So the fact that you can't get PlayStations for your kids is a big problem, and it's going to last, sadly enough. The fact that you don't get your car you order, you will get your car. That's not going to be a problem for a long time. So that's a really, really important difference. Now we're in a situation also when this is turned political, extremely political. So you have European Commission spending 50 billion euros now to spend on semi-factories, which will never be profitable, sorry to say, but they will spend that money, subsidizing Intel and so on, building factories in Germany and so on. You have US CHIPS Act, will spend 60, 70 billion US dollars to build factories in Ohio, Texas, and so on. So this is a lot of money being brought into the industry. Okay, your question to me then, when are we not fixing the problem then? Yes, we are, at this point in time. But we are going to go further, deeper down in technology. These factories get old, and so on. Because there's a driver to drive down everything. Next slide. So this is the next arms race. And the arm in two ways. Arm at the company, but also the arms race to drive down the size and to get smarter components. And it's extremely political in itself. We mentioned Apple and the first mover, and you saw their M1 chip. Now you saw a new computer coming for them, costing like $6,000 or something, when they're adding 2 CPUs together, which is quite interesting. Then all the factories need more capacity and so on and so on. Then there's a rumor today that they're starting to use the Chinese government, YMTC, for buying flash memory to settle the political uncertainty in China. So it's also political. So I think this is really, really telling how about the efficiency in the market, what we need, the AI needs to get better, the smarter cars. If you think about those a little bit, you see a smart car really needs to be fast. You can't have a delay, you can't have a reboot, you can't, because then you're going to hit something. So the message back again, the low-end car industry will be solved. The higher end, we will have trouble for many, many years. And we're going to spend a lot of money. I don't know if you've seen it, but TSMC is spending 100 billion over 3 years and so on. So this is going to cost a lot of money. It's huge. And it's not going to be cyclical. It's going to continue for a long while. So that was really my message on my prediction. And over to you, Joakim. Thank you very much.
All right. Do I have sound? Yeah, thanks. Oh, well, Inge, that's really interesting what's happening with the M1 chip. It's really sad to hear about the supply chain restrictions there, because we're investing in some companies that have some super exciting stuff that can actually, that is enabled by this M1 chip and the technology shift that's happening there. So we're really happy to soon be able to bring you those software solutions when those product gets launched, and hopefully we can solve the M1 chip shortage. So my name is Joakim Dal. I'm a partner here at GP Bullhound in our growth fund that I'm primarily focused on, working with portfolio companies like DuckDuckGo, Klarna, Unity just recently that IPO'd, and based in Stockholm, but have come to Zurich quite often this year, actually. It's a lovely city, and we love the outdoors here, and think you have a fantastic country here. And in the asset management team that I'm in, and of course that Inge and Olya is also in, we like to focus on big things and big trends that are shaping the industry and the ecosystem and that enable these big shifts, and software products like, for example, the M1 chip. And one of those shifts is actually payments. So the breakdown or the closing of the street corner banking office is something that we have been investing behind and working with a lot lately. And particularly on the buy now, pay later side, that's a trend that we saw starting very early in Sweden, actually several years ago, but last year really accelerated across the world. So what is buy now, pay later? Well, it's actually, it's consumer credit. So you buy something, say for 100 Swiss franc, and you're able to split up that payment over, say, 2 to 3, 4 or more installments. And this currently has a huge uptake among retailers. More than 40% of retailers are embracing this. They're saying that it takes over a lot of volume from the checkout, primarily disrupting the credit cards in the checkout. So we're seeing that there's a real embrace from retailers using this, because it enables higher average order values, it increases conversion in the checkout, and at the same time, millennials and actually everyday consumers really love this thing because it's so easy to check out with it. You don't need to know your credit card details. You basically just need to know your postcode and your name and your email, and you're done, and you can check out. So a lot of retailers that haven't embraced this are already embracing it, and it's expected to grow to almost $1 trillion in volumes in the next 5 years, less than 5 years. So some of the leading companies here are actually Affirm out of the US, Afterpay out of Australia that was just recently acquired by Square, Klarna from where I'm from, and many more. And I mean, a lot of people are actually concerned right now about what's going to happen with retailers, given inflation, given uncertainty in the world. And well, actually what we're seeing then is that consumers want to have cash in their pocket. So that actually speaks for a solution like consumer credit, which buy now, pay later is. On the other hand, you might have some headwind from increased default rates and yeah, primarily that. So it's going to be exciting to see what's happening in this area during the next few years. And we have Klarna in our fund. It's been performing extremely well, and they are, by all the metrics we're looking at, taking market share over the world. And this is the most favored solution by all retailers. So we feel very good position there. And then another trend that we can look at on the next slide is, of course, the disruption of all things financial and all things fintech, which is in DeFi and what that enables. So if you think about the bank in the old days, you had to go to the regulator and get a permit to operate. You had to get capital from your shareholders to pass the solvency ratios. You had to get that office on the street corner to be able to get clients. And what, of course, the Klarnas and the firms that are regulated as banks today took out of that equation was the bank office, the physical bank office. But they still needed the capital and the regulation. But what's happening in the DeFi space is that you're actually taking away the regulation and the capital also. So all you need to do now to start a bank or an exchange or an insurance company is to write a piece of code or a contract, as it's popularly called, and put it on the blockchain. And basically what you do is then you create a brand and a community that comes and fills this protocol with capital, with users. And the idea is that you can have cheaper insurance policies, better exchange rates, and it has the potential to disrupt a lot of what we're seeing in fintech today, but we're also seeing increased scrutiny from regulators in this space. So the jury is out there whether they will actually disrupt the existing world or not, but I think regardless, they will create a parallel world, and that's just getting started. And that was it from my two trends.
So, grüß Gott, Zurich. I'm Julian Riedlbauer. I'm running the Berlin office of GP Bullhound and therefore the DACH operations focused on corporate finance advisory activities. So if you want to raise money with an advisor, you can talk to my team and me. If you want to make use of the global platform of GP Bullhound and get the access to the US investors via the US team, the London team, and so on, we have this one global platform, and we are operating out of Berlin. Of course, the real money has Olya, Joakim, Per, and so on to invest right straight into your company, but we will find the right buyer for your business. And we actually advise quite a few Swiss companies. For example, Infinigate, we sold the majority to HIG Capital, or advised the company by the majority sale to HIG Capital, or we advised Crypto Finance, and we advised Nemix, a nice, very big Swiss German agency headquartered in Switzerland, on its sale to Merkle, part of the Dentsu Group. So I think Zurich and Switzerland treats me well. We had nice business here, and I'm sure based on Olya's network and our presence here, we can build up on that. And I would like to present here two trends. One trend is AI, automating healthcare at all levels. I think this is very beneficial for everyone here in the room. All of you will grow older, and all of you will need more medical support. And it's nice if you trust not only your doctor, and I mean, for example, I go every year to a skin cancer health check. And I was never sure if the guy actually thinks about buying the next Switch watch or actually looks at my skin properly. And now they have the AI-based software, so he gets a rating, and he takes a picture and compares it with the last 10 pictures of the last 15 years. And then he gets a rating and says, okay, this is something you have to look at or not. So I trust actually the AI system a bit more than my doctor, who is getting older. And therefore, I think it's a great help. A friend of mine is COO at Ada Health in Germany. And that's a health platform and health AI-based system. And for rare diseases, for example, which is not commonly known within the medical profession, they can have better diagnosis, and they can find and detect by the symptoms rare diseases which a doctor struggles with because they are typically not seeing this disease on a recurring time. And also, I mean, here in Zurich, you have this lots of research and also of medical companies and med tech companies that are maybe more coming from the hardware segment with a lot of AI added to it. And I think it will be tremendously beneficial for all of us. Also telemedicine, I think this is a big trend that we all can invest in, watch, but also benefit as a customer. And the next trend I'm looking forward to present here are wearables. I think, quick check, who of you is using some kind of tracker, wearable? And I mean, I'm talking about Switzerland here. You should have a big Swiss watch, not this medical device or the tracker. And I see here in Switzerland some people have the Rolex or the Hublot or Patek Philippe on one hand, on the other arm the fitness tracker. So I guess that's great too that it coexists. And I think this also will be beneficial. I mean, we have had in our firm a friend of a colleague. He didn't know that he had COVID, but the fitness tracker told him that his kind of blood pressure, the pulse and the heart rate changed, and it was an alert on the fitness tracker and health tracker that this might be COVID. He better checks, and he went to the doctor. It was COVID, and he had heart problems afterwards and some kind of long COVID. He wouldn't have detected it and seen it without the tracker. So I think this is also an important trend, and as we can see here, you are adopters, you bought devices, and I'm sure you will buy the next release, and it will be supercharged by AI. Thank you very much. Back to Olya, our host.
Thank you very much. And I'm here to present the last trend, which is affecting every single one of us, but which most of us thought is very, very boring: supply chain logistics. What is supply chain logistics? Is getting components to finished products and then to us as consumers or to customers. It's actually a huge sector. In 2021, the value of logistics sector was 9 trillion. It's 11% of global GDP. And it's expected to grow at 6.5% per year. What's interesting is actually it's a very, very boring and a very decentralized industry. So it involves a lot of companies that really rarely talk to each other or talk to each other per fax and per old-fashioned sectors, because it's a container shipping that then needs to connect to a trucking company. Most of them are very small. So it's a sector that came into prominence because of COVID. We've all had issues with delivery of our, whether it's Amazon packages or, we've obviously heard about the supply chain logistics of the automotive companies. And so that put the sector at the spotlight. And I'm sure you've all read about the prices of containers, which went from 2,000 at the end of 2019 to 12,000 at the end of 21, and are at some point reached 24,000 in between. So it's a sector that's affecting every single business on the planet and every single consumer on the planet. Therefore, automation of this sector is extremely important, and there are quite a number of software companies, but also freight forwarders that are looking at that sector, and we see the investments in this sector increasing staggeringly over the next couple of years. In 2021, there were 11 billion of investments in this sector alone. That's double the amount of 2020, and we've already seen close to 3 billion of investments this year alone, and please remember, we are obviously in March. So most of these are very, very large rounds. I'm sure you've read about Flexport, which was a $1 billion round at the 8 billion valuation. So we see that trend, large rounds in the sector going forward. With that, this is the ending of our tech predictions part, and we wanted to invite to the stage Per Roman, who is the co-founder of GP Bullhound, as well as Ben, who is the partner in the investor relations team, who will address how the market has changed. Obviously, there has been a significant correction in the public markets or in the tech public markets. There's been a lot of geopolitical factors, the invasion of Ukraine, and we would very much welcome for you to come and
Cool. Thank you, Olya. Thank you very much. Thank you all for having us. We're very happy to be here for our first event in Zurich. I think it shows the commitment that we have so many partners here to get to know you today. We are an open house. We want to engage with all practitioners within the tech sector. So please speak to us. You met the team. You met Inge from our listed market portfolio. You met Joakim, who looks after our private markets portfolio. Olya, of course, is developing her first credit fund. And it is my honor to introduce Per Roman to you, co-founder, head of asset management, the man that kind of started this whole shebang off about 20 years ago. Welcome, Per.
Thanks. It's great to be here. Thank you so much. In fact, you probably don't know this, but my very first proper job, if you will, was in Switzerland. I worked for Autodesk, you know, the CAD software company in Geneva and Neuchâtel. That's where it all started.
Very long time ago.
And now I'm back.
Yeah, go full circle. So we're going to talk a little bit about what's going on currently, because these trends, you know, we kind of devised them last year, and gosh, the world has changed dramatically in the last 4 months. I think we're all aware. We couldn't have foreseen such a shift from what was an exciting bull market to a confusing market now. I mean, some of the stats we've been talking about recently, I read that the price of developing or building the average electric car has gone up by $2,000 since November. So if you're a company trying to predict these costs, trying to maintain your margins, there is so much going on, but software is a big part of all that. So Per, how do you, as a technology investor, how do you adapt to what has happened over the last 4 months?
Well, I think for us, in a way, uncertainty and risk is welcome, because when you've had the type of long bull run we've had, the problem we get, particularly last year, is it's hard for us to deploy capital because we don't think the pricing was sound. So while it can be great for you entrepreneurs in the room, I think for us to try to build, you know, long-term risk-adjusted return strategies, this kind of environment in a way is more interesting. It separates, you know, those who know what they are doing from those who are learning still. And I mean, right now it's a very unusual environment because we have the since about 2-year ongoing conflict between China and US, which is very deeply affecting the internet part of technology. And then we have this massive supply chain problem that Inge talked so eloquently about, which is really shifting the sands in our industry. We then have the beginning of what will be a long run of inflation of technology goods, but also inflation outside of technology, which will impact the consumption basket. But interestingly to us, since many technology products are given goods and also typically very cheap, so technology can often benefit when consumers tighten the consumption belt a little bit. Maybe you don't go on holidays, maybe you don't buy a new car, but you sure as hell will continue to have your Netflix subscription, etc. And then we have this horrible situation in Ukraine and so forth, and that's not technology related directly, but I think it absolutely impacts, you know, the psychology of the financial markets. So when we saw during kind of Q4 and January, I think for me quite welcome correction in unprofitable small and mid-cap software companies in the public markets. Then when the war risk came on top of that, it led to an exacerbation and possibly an overreaction. I think we've seen that stabilize, and in fact, I think we made kind of 20% positive returns in the public markets in the last 10 days. So I think we timed that well. But it's really interesting times, but it's also a really, really good time to be a technology investor, because I think COVID more than anything else really opened the eyes to very non-technology people that we need these technologies around us. We see a huge change in the education system, huge change in attitude in the healthcare system, which are ginormous industries, huge change in industrial supply chains. You know, if we're running out of concrete, if we're running out of steel, are we moving it, are we shipping it in the most effective way, are we producing it in the most effective way? If we're running out of beds in hospitals, how do we use technology for preventive care so we can reduce the amount of people that actually have to become sick and goes to hospital? We saw in the schools, I have 3 teenage children, and how the schools, like literally over a couple of weeks, turned from pretty analog into 100% iPad Pro penetration. And now these children are working with these very powerful machines with ease. So that the knowledge they gained during these 24 years will not be undone. And that I think is really, really positive for software. And ultimately, I don't want to be long-winded, but ultimately what's also beautiful with the whole idea of software is it's an efficiency creator. So if you have challenges in the world, like war, like supply chain problems, like if climate change, which is maybe our biggest problem, you need efficiency gain. We need the cars to emit less. We need freight to be more efficient. Hospital, I mentioned already. This is what software can do. Good software can do exactly that. It improves everything a little bit on the margin. But if you improve everything a little bit on the margin, the change in the whole is enormous. And I think makes a lot more impact than when the governments come together in group and try to set climate targets, for instance, but they don't know how to reach them. So they are words and ideas, but through software and through technology innovation underlying software, we can actually reach and beat these targets.
Yeah, okay. So as an investor, though, trying to drive returns with these changes that have happened in the market, where are the sectors then that you are looking into now that maybe you weren't before, that you think you can drive good returns for and are obviously very important today?
Well, first of all, I think all the sectors we have been in are now more attractive to invest in because, I mean, valuations are down between 30 and 60%, depending on the subsector of software. So that's, of course, really attractive. And then particularly with this kind of awakening, I think we find education software, we find software in the whole healthcare value chain from, you know, these kind of things that you buy as a consumer, which is just ourselves improving. Mental health, we think is a very big area for software, but all the way to for instance, drug discovery. So last year we listed a company on NASDAQ that is the world-leading platform for researchers working across these large companies, you know, the Astras, etc., working together to solve very complex problems like rDNA. And when you look at rDNA, what rDNA really is it's a softwareized version of cells that you inject and that retrains what you're doing. And so we're now also carrying, some of us at least, depending on the vaccine you took, carrying software inside our bodies. So that's great. And then, of course, in Europe now and in US, and Inge mentioned, you know, the highly political world we live in. So that's going to drive a lot of innovation opportunity in the semiconductor stack, in the lithography stack. And then I think because of the war, we're going to see a huge increase in spending around cybersecurity. So while we would never, by moral and ethical standpoint, we wouldn't invest in technology that helps the weaponry industry, but we absolutely support defense, and particularly digital defense. And I mean, the amount of cyber attacks that we've seen in the last 4 weeks is unprecedented on a global scale and continues right now when we sit here. You don't hear much about it. I mean, your providers try to pretend it didn't happen to them. But I think if you think back in the last 4 weeks, you've had your banks suddenly not working, maybe just for half an hour. You've had your telecom company suddenly not switching your call, maybe just for 1 minute. You're not noticing, but it's happening. And so we're going to see government spending go up. We're going to see corporate spending go up a lot. So that's really interesting. It's areas we have always invested in, but it's going to be a bigger piece of the pie in the next 12 months, I would say.
Yeah. It's interesting talking about defense technology, a subject that was, well, a sector that was toxic probably half a year ago is suddenly almost an ESG subject. What do you think about that?
Well, you know, we tried to invest kind of and hold companies for 5, 7, 8 years. I think you have to be sometimes careful with these very quick political shifts of wind. I think, you know, kind of the 200 staff at GP Bullhound are mainly quite young people, like mid-30s. They have very strong and clear opinions that a business like ours needs to operate very morally. So I still think for us that there are big parts of what people call defense that we could not get involved in, even though we know the underlying tech, like, let's say, control systems for robotics would be problematic for us. Anything kind of battlefield related. But for instance, if you see one of the challenges that we saw in Ukraine was the reliance on open 3G and 4G. And of course, as soon as you turn into war, it gets turned off. So soldiers had to go back to VHF communication, which is open and inefficient and very unsecure. So I think there's definitely things we can do in the communication arena that will benefit the world at large, and particularly benefit, victims of war so that they can continue communicate, continue get access to internet, continue to get access to true information we find very important. And I think that's also in a way part of supporting a free world. So in a way that's a part of defense. We need to get the truth out to people who live in Russia. We need to make sure that somebody stuck in a hospital in eastern Ukraine gets information of what's going on. That I think we can do a lot of work around.
Yeah, I mean, talking about true information and getting real information out, the FAANG stocks, which we all knew and loved so much, it was such an easy investment. Stick some money in Facebook and it'll keep going up. So we were laughing recently because some Merrill Lynch analysts renamed the FAANG stocks to things like fuel, agriculture, nuclear technology, gold, and security. So the world has completely done an about turn. Is the golden era of FAANG stocks over? What happens next for those types of companies?
Well, I mean, let's be honest, right? I mean, I think most people here are quite tech savvy. I mean, these kind of media ideas like lumping completely different companies together into an acronym never makes sense, right? I mean, you ask me, well, do you like women? Yeah, but I love my wife.
Yeah.
That's only one of 3.5 billion women. Do I like Apple? Yes, it's going to be worth twice as much in 10 years' time. Do I like Google? Absolutely. What they're doing with TensorFlow and AI is changing our world. It will be the world's most valuable company, but maybe in 20 years' time. Do I like Facebook? No, I don't. I think they've reached peak user base. I think TikTok is eating their lunch. And I'm not the only guy thinking that. I mean, they're trading as a value stock. So, the market is already assuming they're going to decline from here on. They'll decline profitably, but it's not an innovation story anymore. Do I like Netflix? No, but I think my kids seem to like it. So to me, they are very, very different companies. I think maybe the most misunderstood of these companies is Amazon, because it's so easy as a consumer to think about the e-commerce business of Amazon, but the value of Amazon is in the AWS service. I mean, Amazon is almost a monopolist in the cloud, which means in practically all software delivery. So that's an incredibly, incredibly powerful position to have. And probably they would be worth more if they shut the e-commerce business down. And that's kind of fascinating to recognize that. But so yeah, no, so I'm long Amazon, Apple, Google.
Okay, interesting.
And I guess it should be TAG, right? Because people love Tesla more than anything else.
Well, that's
right.
True, yes.
And even though our research very clearly showed that there's not enough rare earth metals to ever go to full electrification, but it's a good political story. But I think if you want to invest for 10 and 20 years, you should be investing in hydrogen, because that's actually a clean technology, which electric definitely is not.
Yeah. So I think privacy is also a big issue around those types of companies. I think it's a big developing theme for us. We've invested in DuckDuckGo, which is a brilliant exponent of privacy and keeping your own data to yourself. So I think that's a developing theme for those companies as well. But
can we check, how many in here have used DuckDuckGo? Wow, that's more than I thought, 40%. So this is quite a not known story in Europe, because we don't have big market penetration in Europe yet. But in US, 3% of all search queries now are done in DuckDuckGo. I mean, that's billions of searches a day. I mean, from 0 5 years ago. So, I mean, this is the first company in 2 decades that's given the Google search engine a beginning of the run for the money. I mean, that's properly exciting on a $1 trillion scale exciting.
Yeah, for sure. I have it on my phone. Just instead of Safari, I have this horrible little duck picture. I go to that instead. But all your data's safe when you use it. It's worth considering. I should say, actually, we will open the floor up to questions. So have a think about that. If there's any questions you have, we'll ask you in a second. But just quickly on those big tech companies, you mentioned inflation. Who knows what's going to happen, but it's definitely going up.
Yeah.
Who does that really hurt in the technology spectrum? Is that the big guys or the small guys, or what's your thoughts on that?
Well, with inflation comes issues for consumers, right? So on a net, we have to tighten our belt. So I think it's a net negative to any industry. I think within the technology industry, we still try to deliver efficiency gain. So in a value chain where you, with higher prices, you suffer as an enterprise to create stable profitability, I would argue that the way to at least mitigate some of these inflationary pressures is to invest in more up-to-date software so that you can run your company more efficiently. I mean, a good example of that would be banks who are still largely run on COBOL software built in the 90s, and the software is very non-agile, very heavy to maintain, and lots of money being lost. So I think it can help accelerate the generational adoption of many software systems now that are obsolete. But on the consumer side, I think it's a net negative. And where we don't invest a lot is more the internet side of tech. So think about e-commerce, etc. And there, of course, is a direct negative. I mean, you will buy less holidays, less cars, less sunglasses, less fancy clothes.
Yeah.
But we don't own assets in those spaces.
Okay, interesting. Any questions, just stick your hand up, but I can keep going for the time being. These macro-level shocks, obviously you've been a part of, you built GP Bullhound 20 years ago, you've seen a few of them now. How have they affected the business? How have they helped you or hindered your evolution?
Well, I think as you go through kind of building a company, you have to also face bad times now and then. Otherwise, kind of insanity happens inside a company. You can't stop it, but if it's good all the time, it creates a not so healthy culture. And I think particularly when you are responsible with managing other people's money, you have to have this kind of care, this sense that it's not easy. And I think in the last 10 years, it's been easy. So I think we were really hit hard, obviously, in 2001 when the dot-com bubble burst, because even though we were not a dot-com investor, we were a software and systems investor. And I think you all know how much these companies went down. I mean, they survived our businesses like Apple, Microsoft, etc., but they lost 90% of their value. So that was quite brutal. And for those of you who are old enough here to remember, I mean, there was a long time where people genuinely didn't think that internet would happen and that software didn't work and that it was only for the accounting department to use on a PC, and that was that, right? So that was very tough, and I think it created kind of a hardy culture in our firm that, we work hard, we work long days, we dig deep, we're deeply fundamental, we don't trust the business plan, we'll go out and we'll ask the enterprise that is using the software what they're using it for, whether they like it or not. If it's a consumer app, we talk to the consumers and say, do you really like the service, or are you thinking about switching to another one? Then came the financial crisis in 2009, and in that situation, it was a shock to the world. But I don't think the world lost faith in the idea of money. So it hurt the financial system quite a bit. But it didn't hurt us so much. I mean, from a technology investor perspective, that was rather smooth. And now we have this kind of, then we had the COVID shock. And it's almost embarrassing to say, but I mean, for us, that was a net positive. And, it's not easy to talk about net positive when you have, your friends' relatives are, in hospital. I mean, it's horrible, right? Yeah. But the awakening was positive. Since we as an investor tend to invest with founders we have known for a long time, even during lockdown, we could continue to invest, and of course at much better terms than in the market in general. So that turned out for us to be an interesting shock to the system. And now this shock is so new, I think, and it's several shocks at the same time. So I think we're managing a little bit hour by hour. And I listen a lot to Inge, because since he's in the stock market all the time, he really has a feeling, almost minute by minute feeling, I would say. And that helps us in private equity quite a lot. And I would say if I look at the investment bankers, who are very active out on the streets with entrepreneurs, so hands-on, they're telling me that the going is still good, that the appetite from the Apple and Microsofts and Facebooks, etc., to acquire is as strong as ever because these companies are flush with cash, ultra profitable, and need to acquire innovation. Will it last? Right? Who knows? But what I do like is that some of the fraud of the market has come off, and I think that's quite healthy. I don't think it's healthy with a war, don't get me wrong. So I think the reasons for the healthiness are really bad. But I think the consequence for my day-to-day job and the 200 people in this company, it's a learning. And particularly since we have quite a lot of very, very bright young people who work with us, but who have really only been in the labor market, from 2010 and on. So they, in the autumn, they were running around and saying, Per, this is an amazing company, only 40 times forward ARR. And I'm like, do you even know what revenue is? Recognized revenue, that is, And they're, Per, we're going to miss out. And now I think that discussion is a bit better.
Yeah, that's interesting. So thinking about the future then, obviously GP Bullhound is now 12 offices, nearly 200 people.
Yeah.
We have $1 billion under management. We manage the money of 300 technology entrepreneurs, which we're very proud to do. What's next? What's the ambition for GP Bullhound over the next 10 years?
Well, I feel very strongly that it's exactly like the first day we started. We wanted to help the people in the world that are willing to take the personal risk and the family risk of going out and trying to make some innovation or change that could make the world better in some way. I think it's an enormous bravery. These women and men are all heroes to me. And all the services around that, M&A, block trading, secondaries, primaries, fundraising, IPOs. We launched a SPAC in January to help founders go public in a more controlled way. Our investment products that kind of put our own capital and the capital of friends back into what we think are the very best and bravest of these ideas. I mean, what could be more fun and lovely than that? I mean, we just keep on growing. As long as the world wants what we do, and as long as there is innovation going, we'll keep on going. And so I think right now we're executing what we call Strategy 2030, where all the partners from all the offices, well, it's 25 partners, have all come together and really built together, invested into a very dedicated plan, a real bottoms-up plan. And so I think by 2030 we'll be 500 employees, be 20 offices, I guess 5 billion under management. But it's not because we're trying to achieve a number. It's because we're trying to achieve this support system for great founders.
Yeah, I think we have the founders clock right up here, actually, which is the principles we've been based on for 20 years, which is putting the founder at the heart of everything we do and being there on the journey.
I mean, people think about companies as logos, right? Use like Coca-Cola, Apple, but behind these logos, there are humans that are either coming up with great inventions or not, and then they're falling on the wayside. And there are so many technology companies that we don't even remember the names of these days, right? Because they stopped having that spirit of innovation and change.
Yeah. Any questions for anyone? No, I think we've covered the whole world and all the politics of the last 20 years.
This is the Swiss discretion.
And oh, sorry, yeah. We just there's a microphone there that's winging its way to you right now.
I actually have about 6, but I'll try. Okay, quick question on. You talked about the lack of minerals to go fully electric, and there's a Hyperloop company based here in Switzerland. Is that something that's come across your guys' desk at all, the future of that aspect of transportation?
I think that is super exciting. I've been following that project for many, many years. It's outside of our investment area since we are a software investor, and this, of course, is a lot of hardware. But it's incredibly relevant, right? I mean, any reduction of friction that you can create, whether it's through vacuum in a Hyperloop or through, for instance, magnetic propulsion, will reduce footprint, will make things more efficient, and that is how we can save this planet. So I think it's highly relevant. I think it's a type of program where I think Europe and Switzerland and other countries need to get very involved on a government level, because it's very hard to attract large amounts of private risk capital to these projects, because the vastness of the capital that you need to put in and the time length to return is significant. So it requires very patient capital. I mean, we saw that in solar, for instance. I mean, thin film solar, which is now kind of at 12.5% efficiency or so, it's been a very, very slow development, right? So as a venture case, it's been pretty bad. But for instance, for the Audi family in Germany, the BMW family, they've been a very successful investor in this space because they've been able to say, well, we can wait 50 years. And then I think very vast returns are going to come through.
And one quick question on fractionalization without going too much into blockchain, but applying it to the financial services industry. Are you seeing any companies that are sort of coming from the traditional space, let's just say insurance, and there is a concept of, let's say, these microtransactions. So let's say you ride your bike or you drive a particular route, and along the way there's one particular roundabout that's more dangerous than others. And you can have a sort of, maybe let's call it a smart contract with your insurance company, and every time you enter that intersection, you top up your life insurance by X amount of money. And if you safely go through it, you go back down to your regular payment. And these are the kind of things that I can see traditional finance companies embracing the fractionalization concept that will drive a lot of change and hopefully financial inclusion on the blockchain side.
I think that's a brilliant startup idea. I think you should start that company.
Yeah.
I'd buy that smart contract. I can ask her, maybe more general answer is, do I think we will see decentralized tokens in the traditional financial services industry? 100% yes. The idea of traceability and reducing this almost quirky idea of trust that we have in the financial system since kind of 1913, when we decoupled from physical gold. We're believing we're owning shares, but there are no share certificates. There's hardly a ledger, right? It's fascinating that it can even run. So will we have it? Absolutely yes. I'm also very excited about tokens in the drug industry, because, I mean, again, we're going to the pharmacy and we believe that we're putting into our body what's there just because of trusting a logo on a plastic wrapper that you can produce for 1 cent. So I think in that, I think we can create a lot more efficiency and a lot more safety in society. And then, then all these other positives that come through that as well in fractionalization, yes.
But we have to overlap that with timing, though, don't we? We always talk about timing, because there will be flying cars one day. It's just if you invest in flying cars now, you're probably going to lose your money. So it's about timing it into the life cycle that you can make a return from.
Yeah, and I'm sure you all have different investment strategies, but I think for us, is one of our tenements is, as laymen, and even in our professional work, we spend a lot of time with future technologies, but we don't deploy capital. We only deploy capital when a future technology is starting to become an adopted technology, when we actually see it's being used in enterprise, in schools, in hospitals, with consumers. And the financial services industry is also one of the hardest regulated industries on the planet. And regulation is the worst enemy to innovation ever. The regulatory sense of protection is the slower of improvement. So it's going to take a long time. The incumbents have very little to gain, so they will only start moving once they are truly threatened. We are obviously seeing that with the neobanks, for instance. I mean, we're an investor in Revalued, you also have N26 and Monzo. They're all doing a really good job in showing the traditional banks that you can communicate with your consumer in a better way and charge a fraction of the cost and still be profitable. So then that's pushing change, but it comes in slow and small steps, I think.
There was a question over here. Yeah.
Metaverse is something which was not in your predictions. Does that mean you're not very excited about it, or you don't see opportunities there yet? We'd love to hear your views.
Well, one is we have as a rule that we cannot repeat predictions, and we've already written about it a few years ago. I mean, it's a very old idea in our industry that Mark Zuckerberg basically stole to just rebrand this bad business. And we already live in metaverse. I mean, a Zoom call is definitely a metaverse experience. It's just kind of, from a UX perspective, pretty basic still. And, you know, if you have any of you have teenage children? Yeah? So it's very high likelihood that your children have played games like Minecraft or Roblox, which is absolutely true metaverse experiences. I mean, the next level is just that you put on an AR headset and you feel more immersed, but they're absolutely metaverse experiences. I think this is inevitable. I think already today we're highly augmented. I mean, we are already carrying a brain in our pocket. I mean, we're using so much inside the phone all the time. We're connected to the internet all the time. We're already, in my view, living partly in the matrix, if you will. I don't know anybody's phone numbers anymore. It's a good example of that. You know, when I drive, I'm totally reliant on Google Maps, and I never remember street names anymore. I mean, it's a sadness in a way, but it's just what it is, right? So I think we're going to gradually shift into more of a meta-like experience. Do I believe that humans want to spend the vast majority of their time inside some form of cartoon-looking 3D environment? No. I don't think so. I still think a real date is better than a virtual date, and a real dinner is better than a virtual dinner. But I love it because I love when technology improves our lives in such a silent and soft way that we almost don't think it's there for us. It just feels like utility. And I think ultimately that is what metaverse is to me, is utility.
There's been quite a lot of money going into selling virtual land, the whole NFT craze. Do you think it's a bit like the dot-com boom, or do you think there's real...
Yeah, so I think these fantastic experiences like Decentralised and Sandbox, in my opinion, are worth zero. I mean, zero. Because since you in technology can infinitely expand the land, by nature of infinite supply, the value must be zero. So it's a cool marketing stunt to open up better use cases. I mean, we have a lot of influencer friends. I spent New Year's with Logan Paul, that maybe you guys know. So he's one of the big money makers in this. So they launch cryptocurrencies in these lands all the time. They spin it on TikTok, make money, and then sell it and move to the next asset. So I'm respectful of that. Like an entrepreneurial gig, it's pretty cool. As a business, it's a different story. However, I would say, I mean, NFTs, though, I think are absolutely going to be around. There is a company in New York called Masterworks. So what they do is they buy famous paintings, like a Van Gogh, and then they fractionalize it so that you or me as a consumer, we can own 2,000 of a Van Gogh and thereby play in the art market. I can imagine, you know, nifties of classic cars. I mean, one day we will not have combustion cars anymore, and those that are left are going to become very valuable because they become scarce. So then would I buy a nifty in a Ferrari? Of course I would. 488, they're beautiful. They're going to be super loved in 20 years' time when you can't buy them anymore. And yeah, so I think nifties are absolutely real. But I think we are very much in that exploratory phase right now. And I love entrepreneurs who take those risks, and I honor them all the money they're making, right? But you ask me, would I pay $500,000 of real money for a pixelated monkey to put it on my Instagram profile? No, I would not do that. But I have a very good friend who just did that, and he's super happy about his monkey. So, you know.
Great. Well, any other questions from anyone? If not, I think we should wrap it up there. Thank you for your engagement. Thank you for coming to meet us. Please reach out to us. And we look forward to doing another one of these soon. So thank you very much.